I want you to ignore the $9,000 in profit for a second. Ignore the 100% history quality bar at the top. I want you to look at the only number on this entire sheet that actually matters, the number that separates a gambling algorithm from a mathematical certainty. Look at the bottom right corner, consecutive losses count, 2. In 200 trades, executed over thousands of market hours through high volatility news events and quiet Asian sessions, the Williams Forex Robot Reversal never lost more than 2 times in a row, not once. While the rest of the retail trading world is screaming that the trend is your friend and blowing their accounts on false breakouts, this algorithm was quietly printing an 87% win rate by doing the exact opposite. Today, we are not just looking at a screenshot. We are going to perform a forensic audit of the Williams reversal strategy. We are going to dissect why this robot wins 89% of its long positions. We are going to confront the uncomfortable truth about its drawdown, and we are going to mathematically prove why chasing trends is the fastest way to go broke. If you want to know how to turn a $10,000 deposit into nearly $20,000 with a Sharpe ratio of 8.39, you need to shut off every distraction and pay attention. Let's start with the impossible statistic. An 87% win rate is usually a red flag. In the world of MQL5 programming and expert advisors, if I see a win rate that high, my first instinct is that the robot is running a dangerous martingale grid that holds on to losing trades until the account explodes. But look closely at the data. We have 200 total trades. 174 of them were profit trades. That is not luck. That is a statistical edge. But the critics will point to the average win trade versus the average loss trade. The average win is $211. The average loss is $1,037. The risk to reward is inverted. A novice trader looks at that and runs away. A professional quantitative analyst looks at that and asks, does the win rate justify the risk? Here is the math that the gurus won't teach you. If you win 87% of the time, you can afford to have your average loss be 5 times bigger than your average win. The report shows a profit factor of 1.36. This means for every dollar this robot lost, it brought back $1.36. It is a machine that prints money by sniping small, high-probability reversals rather than gambling on massive home runs that never happen. This is the difference between hunting with a shotgun and hunting with a laser. Now, let's talk about the reversal philosophy. Why does this work? Look at the short trades versus long trades. It won 81 short trades and 119 long trades. The win rate on longs is nearly 90%. This tells us something fundamental about the market structure this robot is exploiting. Markets drop in panic, but they rise in greed. Panic is fast and unpredictable. Greed is slow, steady, and oscillating. The Williams reversal robot identifies when the sellers are exhausted, when the red candles are overextended, and it enters exactly when the rest of the world is panic selling. It buys the blood. That is why the largest profit trade is $659. It catches the bottom of the V-shaped recovery. So we're going to look at the ugly numbers. Equity drawdown maximal, 19.59%. To make this $9,700, you had to be willing to see your account dip by roughly $3,000 at the worst moment. If you cannot handle seeing your equity curve dip by 19%, you do not deserve the 100% return. Trading is the management of risk, not the avoidance of it. However, look at the recovery factor, 3.15. This is the redemption metric. A recovery factor above 3 is holy grail territory for many fund managers. It means the robot makes back its losses 3 times faster and more efficiently than it creates them. This is why that consecutive loss count is stuck at 2. Even when the market goes against the robot, it recovers so aggressively that a third loss never happens. Let's discuss the Z-score of 0.71. This measures the randomness of the results. A specific Z-score combined with a 96% LR correlation tells us that this equity curve is stable. It is not a jagged line of random luck. It is a steady climb. Look at the 17 consecutive wins. Imagine that for a moment. Imagine opening your MetaTrader 4 or 5 app and seeing 17 blue notifications in a row. That is a God mode run. That streak alone brought in $3,689. That is more than 30% of the initial deposit made in just one winning streak. This happens because the robot does not have emotions. A human trader would have closed the trade after the third win, thinking, "I've made enough." The robot stays in. It exploits the inefficiency until the math says stop. We also need to address the expectation of 48.88. This is the value of every single trade you take, averaged out. Every time this robot opens a position, mathematically, you are $48 richer. Over 200 trades, that expectancy compounds. This brings us to the gross profit of $36,000 versus the gross loss of $26,000. This is high-frequency turnover. The robot is active. It is not sitting on its hands. It generated 400 deals. It is constantly probing the market, looking for weakness in the trend and striking. So, who is this for? If you are a trend follower who needs a 1-to-3 risk-to-reward ratio to sleep at night, this will terrify you. But if you are a pragmatist who understands that the market ranges 80% of the time and only trends 20% of the time, the Williams Forex Robot Reversal is built for you. It capitalizes on the 80% of the time that the market is confused. It monetizes the noise. In conclusion, the data on your screen is 100% history quality. There are no mismatched ticks. This is a simulation of reality. The Williams Forex Robot Reversal proves that you do not need to be right big to get rich. You just need to be right often. You need to be right 87% of the time. And when you are wrong, you need a recovery factor of 3.15 to fix it before the third loss ever happens. The trend is not your friend. The reversal is your paycheck. Use the data, trust the math, and stop gambling.